Brian, easing in China, rate cuts in the United States, the prospect of some inflationary policies in D.C., dependent on the outcome of the U.S. election. A lot of people asking the same question. Why aren't bond yields higher, not lower?
I think we'll get there. It's going to take a little while. Listen, I think the playbook says when the Fed is easing, you buy bonds, right? People want to lock in rates. It's very rare. In fact, it's never happened before that we've come from such an inverted yield curve right into an easing cycle. And so I think people are missing that the trades more or less already happened. But in the meantime, any weaker data, any Fed easing, people will buy bonds. So I believe bond yields will be meaningfully higher than here. I think it's going to take a little while to get there.
Let's just dig into that word, meaningful. Can we talk about that? You think we're at the bottom of a much bigger range. How big is that range? What is meaningfully higher?
Listen, I came into this year saying 390 to 5, and obviously I'm a little bit off on the low side. So let's say it could be even a little lower, 325, 350. I think when you look at a Fed with a terminal funds rate near 3, the yield curve should be at least 150 basis points steep. So that puts us at 450. If the terminal rate's 3.5 or 4, well, then you go a lot higher. So listen, I don't think we've seen the highs in yields for this longer cycle yet. So if we touch just short of 5%, I think you could see a 5.5% 10-year note. If the Fed does everything right, if the data gets better, and China easing is a big part of that story. So you need more stimulus, more spending, all the things we're going to get. I think you can get 10-year notes outside the range of which we've seen to the high side much later next year.